Welcome back to the Deep Dive. Today we are taking a granular look at Copart Incorporated.
Yeah. We're digging into their first quarter results for fiscal year 2026, which wrapped up back on October 31st.
And this earnings call, it really set up a fascinating debate, didn't it?
It really did. It's this classic story of structural strength versus these near-term cyclical headwinds. The print was decisively mixed.
So our mission today is to unpack that for you. We want to understand how a company can so clearly beat on earnings while, missing on the top line.
And what that signals for the whole salvage industry moving forward. It really highlights the difference between, say, operational excellence, which they showed in spades, and the pressures coming from actual consumer behavior.
Okay, let's jump right in. Let's unpack the core numbers first, because this push and pull is why the stock had such a muted reaction after hours.
Right. So if you look at the bottom line, it was strong. They delivered diluted GAAP EPS of 41 cents.
Which beat consensus.
Yeah, beat it by about a penny, so around 3%. And that translated directly into profit growth. Net income was up a really solid 11.5% year over year.
But then you get to the top line, and that's where the narrative just completely changes.
Exactly. Revenue came in at $1.16 billion.
Which was a miss. The street was hoping for something closer to 1.18, maybe 1.2 billion.
So you end up with just 0.7% revenue growth. I mean, less than 1%.
And that mixed result, strong profit, but really soft sales, it just confirmed what investors were worried about.
Yep. Everyone's weighing that incredible profitability against the weakness in the actual number of cars coming through the system.
So this gets us to what I think is the most striking part of the whole quarter, the margin expansion. How do you grow net income by over 11% when revenue is basically flat?
That is the defining story here. It's all about operational discipline. It's a level of leverage that, frankly, very few companies can pull off.
So what did that look like?
Well, they grew gross profit by almost 5% to $537 million, and operating income was up 6%.
And the margin itself?
The gross margin shot up by 184 basis points. It's sitting at 46.5% now.
That's a huge move on almost no new sales. So how do they do it? I mean, in this high inflation environment, how do you get costs under control like that?
Management says their tech investments are finally really paying off. They're just squeezing more and more efficiency out of their existing yards.
So it's not just cutting costs, it's getting smarter.
Exactly. Facility operations costs actually fell 4.5%. Total operating expenses dropped over 2%.
That's incredible.
It's things like optimizing tow schedules, using tech to lay out the yards better. It means fewer touches per car, which means less labor needed to manage the inventory. It's a permanent efficiency gain.
Okay, that operational side is crucial. But now we have to talk about the elephant in the room.
The volume.
The unit volume. This is what explains that top line miss.
Globally, total units sold were down 6.7%.
Wow.
And even if you strip out the impact of, big storms from last year, the underlying decline was still 4.6%.
And it was really concentrated in their core business.
Oh, yeah. U.S. insurance units, their bread and butter, saw a steep 9.5% drop.
A nearly 10% decline. Now, management's argument is that this is cyclical, that they aren't losing market share. But where did those cars go?
That's the key question, right? Their defense is that the cars aren't going to a competitor. They're just not being generated in the first place.
Rainy.
They're pointing to the insurance data. Collision-paid claims frequency was down 7.5%, so fewer claims are being filed overall. They think consumers are downgrading their insurance because premiums are so high.
So they're capturing their share of a pie that's just temporarily shrinking.
That's the argument. And what really helped them offset that huge volume pressure was pricing.
They have serious pricing power.
Absolutely. Global insurance average selling prices, ASPs, were up almost 7%. And in the U.S., they were up over 8%. The fee revenue they get per car was up over 7% too.
But every car they did sell was just way more profitable.
Much more profitable. And all of this is anchored by their balance sheet, which lets them ride out these kinds of dips.
It's a fortress, right?
Complete fortress. Operating cash flow was over $500 million. They ended the quarter with, $5.2 billion in cash? And $6.5 billion in total liquidity?
With no debt.
No debt. And all that cash is now generating significant interest income, which, also helps juice the EPS number.
So that financial stability lets them focus on the long game. Let's talk about that. They say the pressure is cyclical, but what's the long-term structural tailwind they're always talking about?
It's the one thing that has defined this industry for decades. Total loss frequency, or TLF.
And just as a refresher, what exactly is TLF?
It's just the percentage of accident claims where the car is declared a total loss. It's too expensive to fix compared to what it's worth.
And that's going up?
It is. It hit 22.6% through September of 25. That's up 80 basis points in a year. And management loves to remind people that this number was only 4 or 5% back in the 80s. They think it's heading to 25, maybe even 30% over the long haul.
That feels so counterintuitive, though, with all the new safety tech in cars,
Yeah.
ADS systems, all that. Shouldn't that reduce accidents?
And that's the crucial nuance they always hammer home. ADS does, gradually reduce accident frequency over many, many years.
Right.
But it makes repair costs go through the roof. Think about a bumper today. It's not just plastic. It's full of radar sensors, cameras. So a little fender bender now requires thousands of dollars in recalibration.
Which pushes the repair cost over the car's value much more easily.
Exactly. So the very complexity of modern cars is their biggest structural tailwind. ADS is actually a long-term benefit for them, not a headwind.
So that brings up their competitive edge, their moat. What lets them command that pricing power we just talked about? Management laid out 5 things, right?
Yeah, 5 core indicators that show their auction liquidity is expanding. And this is really the core of their whole advantage.
Okay, let's walk through them. What's number 1?
The first is that a growing portion of their cars are sold via pure sale auction.
And pure sale means no reserve price.
No reserve. It's guaranteed to sell. The fact that insurance companies are comfortable doing this with a, quote, strong supermajority of their cars shows how much they trust the platform to find the highest possible price every single time.
That trust is everything. And the second indicator is probably the biggest number from the whole call.
Oh, yeah. The international participation.
This is the 38% number.
It's just massive. International buyers are paying on average, 38% more for these salvaged vehicles than a comparable U.S. buyer.
Why? What's driving that huge gap?
It's a mix of things. Global demand for specific parts, especially from places where they're scarce or more expensive. A wrecked car here can have high-value components, powertrains, specific metals, even the ADS systems themselves that are worth a fortune overseas.
So their platform is basically tapping into a global arbitrage opportunity that a local yard just can't touch.
Precisely. That 38% premium is the engine of their competitive advantage.
Okay, so what are the other 3 indicators?
Number 3 is just more bidders. They have more unique bidders per auction than ever before. 4th is more pre-bidding activity, so more engagement before the auction even starts.
And the 5th one ties it all together for the insurance carrier.
Right. All-time high gross returns, which is just the salvage price divided by the car's pre-accident value.
It's the metric that shows the insurance company how much of their payout they're getting back.
And that 38% premium from international buyers feeds directly into making that number a record high.
And we also saw they're getting stronger in other areas, not just U.S. insurance.
Yeah, their diversification is paying off. Dealer unit sales were up over 5%. Their heavy equipment platform, Purple Wave, grew its transaction value by over 10%. It gives them stability when the main business is soft.
And they're still getting more efficient.
Oh, yeah. Cycle times in the U.S., how fast they process a car, are down 9%, which led to a 17% drop in inventory.
Less cash tied up in cars sitting on the lot.
Exactly. It all feeds back into those amazing margins.
So on guidance, they didn't give any numbers, which is typical for them. But they just reiterated the same priorities.
Margin expansion, international growth, and smart capital allocation. Buying back shares when it makes sense, which they can easily afford.
And it's important to remember the context here. The stock was already down to, 35% from its high before this call.
Yeah, a lot of this bad news on volume was already priced in by the market.
So the debate for you as a listener is pretty clear. Is this volume drop just a cyclical pause, like management says? Or is it something more serious?
Analysts are definitely split. You saw some trim their price targets, but most are holding neutral or positive ratings. They still believe in that long-term total loss frequency story.
And what's interesting is, if insurance rates ever soften, that could be a huge future tailwind.
It could reverse the whole trend. If coverage becomes more affordable, those units that disappeared might come flooding back into the system.
All right, that brings us to our favorite part of the show, the "This is not financial advice" segment.
Okay, so let's pitch an idea. The market is completely obsessed with this near-term volume story, right? The stock is derated.
But the fundamentals are rock solid. Debt-free balance sheet, $6.5 billion in liquidity, margins are expanding.
It's a fortress. So we propose a sort of two-part asymmetric value play. It's centered on those long-term structural drivers.
Okay, lay it out. How does it work?
The foundation is simple. You establish a long position in Copart shares at these levels.
And part two.
You help finance that purchase by selling deep out of the money, long-dated put options. I'm talking strike prices way down in the low 30s, below even the most bearish analyst target.
So you're effectively getting paid a premium to bet that the company won't completely implode. You're using that huge balance sheet as a floor.
That's the idea. You're getting paid to bet against the absolute worst case scenario. Then you take that premium you just collected.
And you buy some upside.
Exactly. You use it to buy a call option spread maybe 2 or more years out. You're trying to capture that eventual recovery, that inevitable march of total loss frequency toward 25 or 30%, which is all fueled by that 38% global premium.
So it's a structural bet on the long term, funded by the market's short-term panic.
That's the play.
So to sum it all up, we've seen Copart transform basically zero revenue growth into almost 12% net income growth. It's a masterclass in efficiency and pricing power.
The challenge, no question, is unit volume in the U.S. insurance business. But all the long-term indicators, that global demand, the auction liquidity, the structural TLF trend, they all suggest that their competitive advantage is just getting stronger.
So the final question for you to think about is this. Does that 38% premium that international buyers consistently pay, does that become an irresistible force? Does it eventually pull every single major insurance carrier onto this platform, no matter what's happening with cyclical noise?
A question to ponder. Thank you for joining us for this deep dive into the Q1 FY26 earnings call. We'll talk to you next time.